Dear students, welcome to the session on financial and operating leverage. The use of fixed charges sources of fund such as debt and preference capital along with owner's equity in the capital structure is known as financial leverage or gearing on equity or trading on equity. The financial leverage employed by a company is intended to earn more on the fixed charges fund than their cost. The surplus will increase the return on owner's equity. The role of financial leverage in magnifying the return of the shareholders is based on the assumption that the fixed charges fund, such as loan from financial institutions and other sources like debentures or bonds, can be obtained at a cost lower than the firm's rate of return on net assets. So, the difference between the earnings generated by the assets financed by fixed charges funds and the cost of funds is distributed to the shareholders in the form of earnings per share, and it increases because of this reason. So, the EPS, that is, the earnings per share, is calculated by dividing profits after tax, otherwise called net earnings, by the number of shares outstanding. So the variability of earnings before interest and taxes, that is the operating profit, and the earnings per share distinguish between two types of risk, that is the operating risk and financial risk. Operating risk or business risk can be defined as variability of earnings before interest and taxes on account of changes in sales and expenses. The fluctuation of sales happens on account of changes in economic conditions and events relating to product lines under boom or recessionary situation in industry. So, the variability of expenses may bring variability in prices of factors of production and the technological changes. We shall now proceed with an example to explain the computation and the implications of operating and financial leverage.
In a scenario where the number of units produced and sold, let us assume as 500, and the selling price per unit is ₹1,000, and variable cost ₹600 per unit. In such case, your sales will become ₹5 lakhs. When the number of units produced and sold is 500, your sales becomes 5 lakhs. And your variable cost becomes 3 lakhs, which is at the rate of 600 rupees per unit into 500 units. Then in that case, your contribution will be sales minus variable cost, which is ₹2 lakhs. And if your fixed operating cost is ₹1,50,000, your EBIT or operating profit will be ₹50,000. Now let us consider an optimistic scenario where we are expecting an increase of sales by 20%. In terms of units, then it becomes 600 units. In that case, your sales will be rupees 6 lakhs. And the selling price per unit remains same, 6 lakhs. And the variable cost becomes 3 lakhs 60,000 at the rate of 600 units per unit into number of units sold is 600. So your contribution becomes 2 lakhs 40,000. From this, let us assume fixed operating cost remains same, 1 lakh 50,000. So your EBIT becomes 90,000. So if you could observe here, your EBIT has become from 50,000 to 90,000. And there is 20% increase in sales or in number of units sold. And in that case, the increase in EBIT becomes 40,000 of the base of 50,000, 100, which becomes 80%. So operating leverage, nothing but the tendency of operating profit to vary disproportionately with sales. So this happens both in the pessimistic as well as in the upside as well as the downside scenario. Supposing the downside scenario is 400, let us assume. Again, there is a fall by 20%, let us imagine. Number of sales, number of units sold is falling down by 20%, let us assume. In that case, your sales will be rupees 4 lakhs and your variable cost will be 2 lakhs 40,000 and your contribution will be 1 lakh 60,000, and when we assume the fixed operating costs remain the same, your operating profit becomes 10,000. Again, there is a fall by 40,000. So 4 by 5 into 100. There is a fall by 80%. So it works both in the optimistic as well as in the declining or in the pessimistic scenario from the baseline. So the degree of operating leverage can be calculated using this equation. The equation is contribution by EBIT, earnings before interest and taxes. So here in the base case, in the baseline case, it is 2 lakhs by 50,000. So it is 4 times. The leverage is 4 times. It means 20 is to 80. Nothing but 1 is to 4 times. In other case, alternatively, this can be calculated as degree of operating leverage is equal to change in percentage of sales divided by change in percentage of EBIT. In that case, 20% divided by 80% is nothing but 1 by 4. 25% is your degree of operating leverage. So operating leverage indicates the operating risk. So a change in 20% in sales brings about 80% change in the operating profit. Suppose we assume that the EBIT is rupees 50,000 less interest is rupees 10,000. So your EBT, that is earnings before tax, will become 40,000. And assume that the tax rate is 50%. So your amount of tax on 40,000 becomes 20, and your earnings after tax becomes 20,000. So number of shares outstanding, number of equity shares outstanding is 10,000. In such case, the earnings per share becomes earnings after tax divided by number of equity shares. So this becomes rupees 2. And in a scenario where the EBIT increases by 20%, that means rupees 60,000, it becomes 60,000. Assuming same rate of or the amount of interest, your EBT becomes 50,000. Less tax rate, 50% of 50,000 is 25,000. And your earnings after tax becomes 25,000. Assuming the number of shares outstanding is 10,000, your EPS becomes 2 rupees 50 paisa. So from this you can observe when there is 20% increase in EBIT, that is operating profit, there is 25% increase between this. So financial leverage is the tendency of EBIT, EBT, earnings before tax, to vary with changes in EBIT. So parallelly, your after-tax profit as well as EPS. So your change in the EBIT impacts on the change in the EBT, EAT as well as the EPS. So the degree of financial leverage, degree of financial leverage is based on the equation you can calculate. EBIT divided by EBT. So here it is 50,000 divided by EBT, which is 40,000. So 1.25 times in the baseline. Whereas here it is 50,000. EBIT is 60,000 and EBT is 50,000. So it is 1.2 times your financial risk level decreases because of increase in your EBIT. So there is a tendency of your EBT to vary with changes in EBIT, operating profit.
So there is a tendency of earnings before tax to vary with changes in earnings before interest and taxes, that is EBIT. From the above example, you would have noticed that for a given degree of variability of EBIT, that is earnings before interest and taxes, the EPS, the earnings per share, increases with financial leverage. The variability of earnings per share caused by the use of financial leverage is called financial risk. Firms exposed to same degree of operating risk can differ with respect to financial risk when they finance their assets differently. A totally equity financed firm will have no financial risk, but when debt is used firms add financial risk. While financial risk is avoidable, the operating risk is unavoidable. So, financial leverage magnifies shareholder earnings. The variability of earnings before interest and taxes causes earnings per share to fluctuate within wider ranges with debt in the capital structure. The degree of operating and financial leverages can be combined to see the effects of total leverage on earnings per share associated with a given change in sales. So, the degree of combined leverage is equal to the degree of financial leverage multiplied by the degree of operating leverage. Otherwise, it is equal to the percentage of change in EPS divided by percentage of change in sales. Operating leverage and financial leverage together cause wide fluctuations in earnings per share for a given change in sales. If a company employs a high level of operating leverage and financial leverage, even a small change in the level of sales will have dramatic effect on earnings per share, that is the EPS. Hope after listening to this lecture, you are in a position to understand the effect of operating cost and finance cost on the earnings per share when there is change in sales. Thank you.